Hi, and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's see the analysis.
Yesterday, February 19th, 2026, Immunic, ticker IMUX, closed at 97 cents and 5 cents. That represents an 11.1% gain for the session, which is, nice, but frankly, it's a bit boring. Here is the number that actually matters right now: 64 million shares.
Yeah,
That is the volume we saw just absolutely explode last week on February 13th. That is not retail traders buying a dip. That is a tectonic shift. We are looking at a stock that was drifting at around 61 cents in January, suddenly waking up, and the market cap is now sitting somewhere between $105 and $117 million.
right. But it wasn't a shift, it was a flood. We know exactly why that volume exploded: a massive $400 million private placement, a pipe that effectively drowned existing shareholders in new paper. You're celebrating the water rising while the ship is, actively taking on weight.
Boris, it was the exact moment a distressed biotech finally became a real commercial contender. The catalyst was the raise, yes, but the question isn't just about the volume. It's about the future. Is Immunic just selling the furniture to keep the lights on, or did they just secure a fully funded path to a potential $9 billion valuation based on a highly unique neuroimmunology platform? I'll be taking the bullish perspective today, arguing that the science and the upside justify the structure.
And I will be taking the skeptical view, arguing that this financing is, frankly, a Pyrrhic victory that structurally damages shareholder value, and that the scientific risk here remains entirely binary.
Fair enough. Let's lay out our core cases then. I'll start. My position is that Immunic has successfully transitioned from a risky research firm to a late-stage commercial contender. The bear case for the last 2 years was simply they will run out of money before the phase 3 data reads out. Well, that argument is dead. The $200 million upfront from this raise, plus the warrant potential, funds their operations through the critical INSURE trials in late 2026 and well into 2027. Bankruptcy risk is off the table entirely, and the asset, vidofludimus calcium, is a first-in-class Neur1 activator. It targets neurodegeneration directly, which existing drugs just failed to do. Combine that with the fact that Simona Sherkinich, the woman who led the Ocrevus launch at Roche, just joined as interim chairperson, that signals serious commercial intent. The market is pricing this like a bankruptcy candidate, but the fundamentals point to a potential 75x upside.
I think mispriced is a highly generous way to put it. I look at this financing and I see a company that just mortgaged its entire future to survive the present. My thesis is that the cost of capital here is devastating. They issued 229 million pre-funded warrants. The share count could balloon by 5x, maybe even 10x. And we are operating in the graveyard of neurology. Phase 3 trials in this space have a historic failure rate of, 50 to 60%? If INSURE 1 or 2 fails, the stock goes to zero. And we can't ignore the compliance issues. The stock is under $1, and they are explicitly planning a reverse stock split of at least 10-for-1 to meet NASDAQ rules by June. Historically, that crushes retail investors. This is strictly a show-me story. Until that data reads out in late 2026, you're holding a lottery ticket that keeps getting diluted.
I understand the skepticism on the structure, so let's dig right into that financial architecture first. You're heavily focused on the dilution, which, I will admit, is heavy.
Heavy is an understatement. Look at the actual terms of the February raise. 229 million pre-funded warrants priced at roughly 87 cents. That creates a massive share overhang. Every time the stock tries to gain momentum, a fund exercises a warrant and dumps supply. It's an artificial ceiling. But the part that really signals desperation to me is the Series B warrant restructuring.
You mean the cleanup of the old warrants?
Cleanup is a very polite word for it. Immunic had to go to the old Series B holders and essentially bribe them to cancel 51 million old warrants. They granted a 5% synthetic royalty on future sales just to get those warrants off the books.
Right, to clean the cap table.
But do you realize what that is? It's a tax on future revenue before they've sold a single pill. They are eating their own future profit margins just to survive today. That tells me the lenders had absolutely all the leverage in that room.
I hear that, but you have to look at who is on the other side of that table. Without this deal, Immunic was facing a cash cliff, zero runway. Now they have a clear path into late 2027.
And look at the investor quality here. This wasn't some predatory retail financing. This was BVF Partners, OrbiMed.
RA Capital, yeah.
Exactly, RA Capital. These are some of the smartest funds in healthcare. They didn't just throw $200 million at a dying company. They doubled down because they looked at the data. They aren't worried about a 5% royalty. They are looking at the other 95% of a potential blockbuster drug.
Smart money can still be wrong. We have seen those exact funds blow up on biotechs before.
True, but they are betting on the long game. That royalty aligns those major holders with the commercial success of the drug. They traded warrants for a royalty because they actually believe there will be sales. The dilution is simply the price of admission to get to the phase 3 readout. If you're an investor sitting at $0.97, you aren't sweating the warrant overhang if the drug hits. You are looking at a multi-billion-dollar asset.
If the drug hits, that is the operative phrase for this whole debate. So let's pivot to the science, because that's where this valuation lives or dies. You are banking everything on vidofludimus calcium.
I am, and the biology backs it up. Existing MS drugs, they put out the forest fires, right? The active relapses. But they completely miss the smoldering coals underneath. That is PRA, progression independent of relapse activity. Patients get worse even when they look perfectly stable on an MRI. They lose mobility, they lose cognition.
Everyone talks about PIRA now. It is the biotech buzzword of the year.
Because it is the biggest unmet need. Vidofludimus calcium is fundamentally different. It's a dual mechanism. You have the DHOD inhibition for the anti-inflammatory side, plus the Neur1 activation, which is purely neuroprotective. It stops the smoldering. And, crucially, look at the safety profile. They have a 2,700 patient safety database showing no liver toxicity and no serious infections. That is unheard of in the space.
I will admit the phase 2 data, the Caliper trial for progressive MS, and emphasis for relapsing was good. But phase 3 is a different beast entirely. The endpoints for Ensure 1 and 2 are annualized relapse rate, or ARR. That is a very hard clinical bar to clear. In phase 2, you're looking at MRI lesions, which are surrogate markers. In phase 3, you have to prove you are significantly stopping actual clinical relapses better than a placebo. Can they beat the numbers significantly enough to matter? Neuroprotection sounds great in a slide deck, but proving it clinically is a nightmare.
But there is something else the market is entirely missing here. Everyone focuses on the anti-inflammatory side. Look at the viral data that just came out.
The Epstein-Barr stuff?
Yes, it's revolutionary. The medical community now widely considers Epstein-Barr virus, EBV, to be the likely trigger for MS. In data presented just this month, February 2026, at the ACTRIMS Forum, this drug showed potent antiviral activity against EBV. It hits the inflammation, the neurodegeneration, and the viral trigger. It's a triple threat. No other drug on the market does that.
But that's just a phase 2 retrospective correlation. The FDA does not approve drugs based on cool viral data. They approve them based on stopping relapses. If the drug doesn't hit the ARR endpoint in the Ensure trials, nobody cares about the virus. And let's look at the competitive landscape, because that's where your optimism really hits a wall for me.
Go ahead.
You are walking into an absolute buzzsaw. Roche's Ocrevus sells $6.3 billion a year. It works. Doctors trust it. Kesimpta from Novartis is gaining massive share. Why on earth would a neurologist switch a stable patient to a new unproven pill when they can just put them on an infusion that they already know works beautifully?
Because the much-anticipated alternatives just imploded.
What do you mean?
The brain BTK void. The industry expected BTK inhibitors to be the next big thing. Sanofi's tolebrutinib, Merck's evobrutinib, they spent billions on these. They were supposed to be the oral drugs that crossed the blood-brain barrier and killed Ocrevus.
And they failed.
Catastrophically. They failed to reduce relapse rates effectively, and worse, they had severe liver toxicity issues. The FDA slapped partial holds on them. So now you have a market that is desperate for an oral drug with monoclonal-like efficacy but placebo-like safety. The BTKs failed to deliver that. Immunic is literally the only late-stage oral left standing that doesn't rot your liver. The competition didn't beat them. The competition defeated themselves.
Okay, I will concede that the BTK failures cleared the deck somewhat. It definitely leaves a vacuum in the oral market. But even if they are the last oral standing, we have to talk about the valuation math. You mentioned a $9 billion valuation earlier.
Right, based on peak sales estimates of $3 billion to $7 billion. A 3x revenue multiple is very conservative in pharma.
But let's do the actual math with the new share count. This is what investors miss. They see $9 billion and think the stock is going to $100. Let's walk through it. Following this February raise, if you account for the pre-funded warrants, the matching common warrants, and the future capital they will inevitably need to actually commercialize the drug, we are looking at a fully diluted share count of probably 1.2 billion shares.
Yes, that is a fair estimate for the fully diluted outcome.
So, take your $9 billion valuation, which is a perfect world scenario, and divide it by 1.2 billion shares. You get a share price of $7.50.
And the stock is at $0.97 today?
Right, but my point is the ceiling isn't $50 or $60 like it might have been before the dilution. The ceiling is maybe $7.50, and that takes 10 years of flawless execution. It's a great return from $1, sure, but is it enough reward for the risk that the drug fails completely in 10 months?
In a zero-interest world, absolutely it is. Where else are you finding an asymmetric bet with an 8x return potential, where the downside is strictly capped by cash on hand? A move from 97 cents to $7.50 is an incredible portfolio driver, and frankly, you are ignoring the free option entirely.
You mean the secondary pipeline, IMU856?
Yes, the SIRT6 modulator. Immunic is not just an MS company. This drug is targeting celiac disease and, more importantly, obesity.
Oh, come on. Every biotech nowadays claims to have an obesity play just to pump the stock.
The data is there. In February 2025, they released data showing a 250% increase in endogenous GLP-1 levels. Even if the MS drug is just mediocre, the obesity pipeline alone could be worth billions. It's a completely separate mechanism.
It is a distraction. Right now, as we sit here in February 2026, this is an MS company. If the insured trials fail late this year, nobody is going to care about early-stage celiac data. You can't value a company on a lottery ticket inside another lottery ticket. But we have to address the elephant in the room: governance and the reverse split.
It's procedural, but go ahead.
It's a steamroller for retail momentum. They have until June 22, 2026 to regain NASDAQ compliance. Filings confirm a reverse split of at least 10-to-1 is planned. We had that bullish crossover in mid-February. Technically, it looked great. But if they execute a 10-for-1 split, history tells us the stock will likely drift lower immediately after. Retail investors absolutely hate reverse splits.
Retail hates splits. Institutions require them. That's the disconnect here. A 90-cent stock is uninvestable for many major funds. Their charters literally forbid buying penny stocks. A $10 stock with a clean cap table, that is accessible. Do you think Simona Skrjanek took the chair role to oversee a delisting? She's there to sell the drug or sell the company.
That's a nice theory, but in practice, reverse splits wipe out the little guy. The data doesn't come out until late 2026. That is a long time to ask an investor to hold a volatile stock undergoing a reverse split.
The clock is ticking down fast.
Enrollment finished last June.
It is, which brings us to the conclusion here. I will acknowledge that this massive cash raise removes the immediate bankruptcy risk. They aren't going under tomorrow. But the binary risk of late 2026 is the only thing that truly matters. Investors must be comfortable with the extreme volatility of a reverse split and the 50% chance the drug just fails in phase 3. It's a high-risk play, not a guaranteed investment.
And my summary is this: the dilution was heavy, but it was absolutely necessary. We have a clinically de-risked asset entering a market where the main competitors have imploded. The floor is the cash they just raised. The ceiling is becoming the standard of care in a $38 billion market. For those willing to wait for the insured data, the risk-reward ratio is rare.
Well, we certainly agree that late 2026 will be the definitive moment for Immunic. Absolutely. The data will speak for itself. Listeners should definitely pull up the ACTRM's data and the recent filings to explore the numbers for themselves.
If you like this video and want to watch more content like this, don't forget to subscribe. Thanks for watching. See you.